then your house is a liability. So I never really understood it, but then I'm starting to really think about it and connecting is like, oh, that maybe that's what he meant. So we need to buy rental properties.
The Abundant Wallet.
Well, I appreciate you taking the time and giving your insights on your experience. It sounds like you've been doing this for 25, 26 years, so you have a great deal of knowledge. I guess interested in, you mentioned capital raising. Do you look for LPs for some of your syndicated deals?
Yeah, we don't really look for LPs, but we give them opportunity more because again, like I was mentioning, Larry, that we have a lot of our capital into these deals, because we believe in it. We underwritten a certain way, and we believe in our team and our partners. And then because Macon is really close to where I live too, and it's about 2 hours away, so I got boots on the ground, and I can always visit the property. But anyway, from the LP standpoint, we're just trying to give them the opportunity to co-invest with us to see if they believe in our operation and also this deal. And some people don't like making markets, which is perfectly fine, because I think you can make money in a lot of different ways. But multifamily, in a way, it's kind of like a lot of people are going underwater right now, and a lot of LPs are getting nervous. And multifamily is supposed to be doubling or tripling your money in 5 years or whatnot. And that was a kind of the thing the operators used to pitch to the LP, saying, hey, you want to double your money in 5 years? You invest in this multifamily. And it's been great since 2001 through, or even 2017 through, 2023-ish maybe.
Yeah.
And in 24, things started to kind of rock a little bit. Interest rate starts to rise, which is still fine. But once the loans started maturing for these operators, then now their interest rate became from 3% into 6-7%. And then they're like, oh, now they're paying the bank much more than what they're paying in the past. And now guess what? They're not cash flowing anymore. And then they started bleeding. And they started to modify the loans with the banks, and they did the 1 year extension, blah, blah. But they can't keep that up forever. So people are going down the drain, and LPs see that, then they're not going to just give $100,000 to just random stranger and make a connection. It's like, oh, double your money in 5 years sounds great. Where should I wire the money? People don't do that.
No.
Never.
Yeah. We have to ask the right questions and do our due diligence just to make sure, what happens if, you don't sell or you don't refi in time. What are your contingencies? And you have to ask all those questions.
Exactly. Loans don't mature to the next 8 years, I think.
Yeah.
Well, we're 5.52% interest on this. And interest only period is a couple of years. So next year is going to be interest only plus we have to pay principal is going to come. So it's going to, kind of dilate the cash flow and everything, but that goes on the principal. So it's not going to really do too much damage on it anyway. But the point is the interest rate maturing is the biggest hit that a lot of these operators are facing. And, they're taking a haircut on the deals that they bought it for $20 million at 2021 or 2020. And then, now that the property value with the NOI going down because the interest rate hiked and now they're paying more. So your NOI is down. So you're giving that cap rate, keeping the same cap rate. What it means is now you're kind of the value of the property, it got depreciated so much that, and now they have to sell because they're not cash flowing.
Yeah.
They're making capital calls, investors going to put money. And what are they going to do with the money that they collect? And they can't really turn it around. So they're going to, eventually they can survive for 6 months to a year, whatever money that people raise, but they're taking a haircut on all this property. So that's what we're job for. Yeah.
I've never been involved in a deal where there was a capital call, but there was a point to, the situation you just mentioned where, you're now paying back principal and the interest rate hike. There was quite a few quarters where distributions were not sent to investors.
Yep.
But hoping the sale or the refi can accommodate for that.
Yeah, a lot of for multifamily operators to sell now, they got to sell it at a discount because there's a lot of multifamily that's on the market right now. So, like, remember 2008 with the single family housing was like the, how do you say with the loan?
Oh yeah,
subprime mortgage rates. A lot of people who shouldn't be buying houses bought a bunch of houses. And then next thing you know is like a lot of people going on the foreclosure. So all these people just, start paying the banks, whatever, because they simply cannot afford it. But they somehow bought the house. It did hurt the multifamily market back then. But what happened is like all the banks started taking over these houses, and the banks don't control these houses, right? Because they're banks are banks. So, and then everybody started to go on the foreclosure. What it means is like banks started carrying all this inventory, which means like, now there's like a flood of all this inventory. The bank wants to just buy or sell for a very cheap price. And then now what happens to the general area is that, hey, the banks are selling the same exact house next door, which is worth 200,000 for like 100,000, like a 50% discount, right? And now saying my house, like I still have a 200,000, like a $180,000 mortgage on it or whatnot, but my house is only worth like 100. So I'm overpaying my mortgage is it's like worth more than what my house is worth. So what happens to these people? Hey, that's ridiculous. So even the people who didn't have issues, they started walking away because my house simply don't worth as much as what I owe.
Yeah, there were so many people that were underwater, and it's just like, I'm paying more than it's actually worth. And I do remember in that span of years, maybe after 2008, where they were walking away. And obviously the bank doesn't want to be in the business of owning property, but if they're delinquent, they have to take it back, but they're going to, sell it at a huge discount. So,
yep. And they don't know how to sell. So like it's a supply and demand. It's like a simple economics of it. Yeah. We have so much supply. We have no demand because everybody's just walking away from their house. And even if they want to buy the property, they need to pay in cash because, if you're going to foreclosure, there's no way the bank's going to loan you the money to buy another property from, so it's got to be cash buyers. So that's why what I was telling you that, when we bought a house for like a higher equity on it, and then we took it back, and like 50,000 at the back end. So the cash was a king back then. So if you have cash, you can buy all these dirt cheap properties. Yeah. Discount like pennies on the dollar, basically. So
yeah.
And that's exactly what happened, back then. And right now with multifamily, it's very similar things are happening. It's not because of subprime, but it's very similar because now the private equity funds, like all this investors into like BlackRock and, with the private equity funds, right? And they just kind of frozen their accounts, they're not really distributing their money, because people want to pull out, but they say, hey, you can't pull all the money out at the same time because what happens that their account's going to get sucked dry. And simply very same as like if every single person in this world, withdraw the money from the bank simply doesn't have all the money sitting in their checking account, whatever. No. So it's the same concept. So the private equity guys are just saying, hey, we're not distributing anything. We're not, nobody is able to pull any money out of the account or nothing like that.
Yeah.
Because from the office space, during the COVIDs and everything. So a lot of the office, the buildings are going under foreclosure because they was kind of surviving in a way because their interest rates are still low. But now a lot of these interest rates are maturing and the office space are really not making as much money as they were before. And a lot of these people are getting, like in a bad position right now.
Yeah. Yeah. So I guess earlier on when you first started becoming an investor, what was some of the like early wins that you saw, like, oh, this is something that I can learn, I can do, and I can make either money additional capital or additional money on the side, or maybe this is a longer term career play?
Yeah, that's a good question. There were a lot of wins and there were a lot of losses, but I think I can tell you, like, I was so young and naive, right? So I'm thinking, first house that I bought was very close to the airport in Atlanta.
Okay.
And, it was my first house, right?
Yeah.
And I was like 2000. So you know what? I bought a house. It's a big asset and I won. I'm like, yes, let's go.
That's all it took.
Yeah. And then my wife wanted to become like, into like real estate. And I asked her, hey, so why don't we get involved in like more real estate, And she became a realtor. We bought a house and then, and let's help people buy houses, So she was doing that for a while. And then we ran into these investors, right? So they say, hey, I want to buy this property, that property. It just like looks a lot of work. But then I don't know exactly how they're doing it, but they're buying for a certain amount that I wouldn't even buy for. I think they're overpaying for that house or something. But somehow these people are buying these houses, they're fixing it and having these buyers at a ridiculous pricing. Like, oh my gosh, this people actually buy in this neighborhood for like 200,000. It's like, oh wow, unbelievable. So I'm watching these things happen. Like while my wife is doing her thing in the real estate realtor market. But then when I learned that, it's like we're helping these people, investors, to make a lot of money. Yeah. And we just bought our house and thinking that we're American dream, and that's an investment. And I read Rich Dad Poor Dad, book, and said, hey, if you think your house is an asset, then you're a fool, because it's actually taking money out of your pocket.
Exactly.
What's asset is what puts money in your pocket, right? So you ask me this question. So you answer this question. So is your house putting money in your pocket? If not, then your house is a liability. So I never really understood it, but then I'm starting to really think about it and connecting it as like, oh, maybe that's what it makes. So we need to buy rental properties.
Yes. Yeah.
And then we started buying rental properties. And that was like the first rental property was like almost like a next door to us. And then that. And then, there was a lot of nightmares with the tenants and stuff. And we didn't know how to screen the tenants. The first person called us, hey, I'm interested in your property. Yeah, sure. You got a deposit? Yeah, I don't have all of it. I'll take half. And, I just sticks whatever person, like first come, first serve, right? And put up there. And guess what? I'm in court because I had to go evict them.
Yeah. Yeah. Self-manage is tough. I mean, now I think there's so many different apps and things in place where it's a lot easier, but back then you couldn't. I don't know, I think a lot of people just did the trust but verify thing and maybe skipped out on some of the trust. I think eventually when you got a lot more properties, you either had a system to self-manage, or you're like, I don't mind paying a property manager to manage these. That way I can concentrate on other things.
Yeah, that's a good question because on the single family side, right, we still self-manage, but it's very easy.
Same here.
It's very easy, because all you got to do is collect rent. And if the person really appreciates it, say, hey, Larry, I love the way you're managing. Every time I have issues with the property, you're not the one going there and fix it. You have your team is like a contractor.
Exactly. Yeah.
And then you say, hey, can you go to that property and call this tenant and they have issues with this and that, or just not even call, just text them,
Exactly.
On the way, they go there, take pictures, send me invoice, I sell them, and that's it. I don't even go there. And we have this relationship. It's like it's so easy to.
Yeah. We do the same thing. A lot of our properties are outside of Florida. We're close to Orlando, but like to your point, the liability, Rich Dad Poor Dad. We started, buying houses, and then when we got on the business side of the investments, we saw how lucrative this was about putting money in our pockets. We actually bought like our primary house, we turned it into a rental, and it's just like, okay, this is cool. Like people are paying our mortgage for us, and we're getting some cash flow. And then we did the same thing. We built another house like in the next city over, and we did the same thing. So, I mean, right now, like we're renting an apartment just because we're kind of in a short-term situation, but eventually I feel like I do want to buy a decent house, but you know, I think it's still that thing where, you know, if it's not putting your money in your pocket, it's taking it away. So it's just like maybe there's a happy medium of you know, all the money you're making from real estate, maybe you can either pay it cash and you're not paying the mortgage, or you have a pretty nice down payment to where your mortgage payment is next to nothing. So,
Yep, exactly. So we got to leverage, like a lot of back then in 2008, I was mentioning, is the properties are dirt cheap. You can buy a couple of townhouses with like a 50,000 or whatnot, but we don't see those anymore, obviously, right? But
yeah.
In any market though, like let's say in 1980s, the houses were like in a certain price point, and then it went up and it went down like 2008, 9, 10, 11, whatever. Then it went back up. It's a cycle, but it never really goes way down like we've seen in 2008 through 2012, 13-ish. Those are like the really special time that all the real estate investors probably got into the real estate investment at that time. But if we missed that boat, we're not going to say it's too late, because, we should have invested it, but then the best time to invest it in is today.
Yeah. There's always going to be those deals,
right?
Some of them are just, the more deals you analyze, the more you're like, okay, a lot of these are not good, but there's going to be some of the diamonds in the rough that are like, it's like a nice steal of a deal. So
yeah, exactly. And you know what, like one of the key points is, like, I was talking to one of the investors, right? So if I buy this house today for it's like 315,000, so should we buy this property in this location for 315,000? So in 5 years, this 315 is going to maybe turn into like 4 years, whatever the appreciation value in that particular market, because you can't really see that, right? Then if you do the math, then it's like 250, whatever that number is, appreciation value. So based on that, I'm only making 4% annually, so it's maybe not really worth it. That's like one narrow way to look at it. But what about your tax advantages? What about your cash flow? What about, like all these things that you get, right? But then it's so much different than stocks, because it will appreciate as long as you start cash flowing. And then in 20 years, like when you pass it down to like your heirs or whatever, for your kids, then that price points is definitely not going to be what the price point today. It's going to be appreciated or it's going to be depreciated. However, though, but if you're collecting like $500 a month additional monthly revenue, not revenue, but monthly profit on these deals, you're already ahead of the game.
Yeah, I think that's a big thing. The legacy component is so key to where, it breaks the 2-generational curse. I'd rather pass assets than cash, because after the 2 generations, if you're passing cash, all that's going to be squandered, right? That's kind of like the difference between the Rockefellers and the Vanderbilts, right? So,
so that's the game we play. We do cash flow, and then appreciation is one thing. Like, we don't really care about that. I don't even underwrite appreciation, except as if it's multifamily, it's a different ballgame. We have to calculate exit. But in a single family investment, like the stuff that we own as a family, we self-manage because we're the only person who cares about making money. The best property manager is basically you. But if you're going to be sucking up too much time managing and creating a big headache, and then obviously it's not for that person. But because of the system and the people we work with, especially, like, you got to be able to collect rent. So the best partner is your tenants. Yeah. Because they're the one who pays your rent. So they got to be your best partner. And your second best partner is the contractors, in case something goes wrong, they're on it right away. And you pay them as soon as they're done that day, say, hey, I'm done. Great. Thank you for getting out there. Just sell them right away, and of course we look at pictures, but we have long enough relationship that I know he did a great job on it. And resident says, great, everything's working great now. Thank you for sending somebody so quickly, even on Christmas or whatever holiday. It doesn't matter. Like if something's going wrong, urgent, we'll be there.
Yeah. Yeah.
So that stuff is like gold.
It really is. That I think that's what makes a great landlord versus not. You're able to fix it quickly, and you just take some money out of your CapEx fund, and
Exactly.
it's going to pay. It's going to pay itself. But yeah, that's true. So are you? What type of deals are you like focused on right now?
We're still looking at Sunbelt, like with the multifamily. We're constantly looking at the 100+ units.
Okay.
So that's our criteria, like 1980s plus. I like the townhouse style apartment complexes.
Yeah.
Worst case, you can break it up into chunks and just sell like individual like doors at a time. But we tend to like keep everything that we buy in a way. But with our partners, like we want to exit 5 to 7 years. So looking at these underwriting from the bank statement, what we don't want to make sure that we underwrite with a 7% interest and still making cash flow. And, the cap rates are really moving a lot. So we don't want to underwrite with the same cap rate that we purchased it for.
Right.
We want to be like really conservative on those numbers. But, everybody says underwriting conservative. But anyway, like those type of deals, multifamily, 100+ units, 1980s around Sunbelt. But even in the certain Sunbelt, I want to avoid, because the property is like overbuilt. But maybe that is a good time to go in because the market is hurt and we're going in cheap, but it's not going to cash flow because the tenants, there's so many competition with the tenants and your occupancy is going to be less than 80 or something. But if you can survive with that underwriting, then the people say stay out of this market or that market. You might hear these things because it's way too oversaturated and like overbuilt from the apartment building standpoint. Brand new building down the street is now offering concessions, 4 months free rent. And you got the 1980s product here barely keeping these people because everybody's jumping ship to go over to the brand new building, and you're losing tenants. But if you can underwrite and survive with like, I don't know, I don't want to throw any numbers out there, but 60, 70%, but you still cash flow break even at that point, maybe it might be worth it to buy it because that's gold in the rough, but we have to be able to manage these things and put tenants in there, add value, but you're competing with a brand new product. So how do you win versus that? So we got to kind of go back to where we're tenants also.
Yeah.
To understand how the tenant feels. But at the end of the day, if the management in the place is clean and somewhat reasonable, we want to stay there, not just because they give you free concession for 4 months and then your rent's like $2,000 a month. Or like in Florida, I'm sure it's much higher than that.
Yeah, I think so. I mean, we're in a 2-bedroom and we're it's not big by any means, but it's functional. So we're paying like just shy of 2,000. So
yeah, okay.
But I think to your point before, I think as a landlord, and if you're trying to be competitive, maybe that's where those amenities come in.
Yep. Attracting like the new tenants to it's all about tenant and a landlord relationship. In a single family world, like you and I are self-managing, like it's okay. It's like when people say, hey, you shouldn't self-manage, you should hire a property management. I completely disagree with that because that's something that we own. If it's easy, then keep doing it. But in multifamily, like 100+ units, you don't want to self-manage that. That's a nightmare. That's like a full-time job. And then like the people who's on-site property management team, they're the boots on the ground. They're the real value. And they're the one who creates relationships with tenants and collecting these rents. I don't care if the occupancy is like 95%, but if you're only collecting 50% of that 95, you're not making money at all.
Exactly. Yeah.
Too many delinquency. Just because they don't pay, we're going to be like pricks about it. Say, hey, you missed the payment by like you still owe $100, so therefore I'm going to file for an eviction. Like give me a break.
Yeah.
no conversation. So like these things is so important to keeping that tenant to landlord relationship, especially the property management. So getting back to your question, definitely 100 plus units. I like that, to keep it that number,
Yeah.
you know, because it's kind of like, it makes sense to put property management on site to run all these complexes to worth their value and time to be there, and to be contracting with this property management company for, you know, like 3 to 4% management fee instead of paying like a 10% on the single family, because it's not enough for them to work with us, you know. But
Yeah.
anyway, yeah,
It's probably too much just for a single family, because you don't have the units. If you know, if they leave, then you're vacant, totally vacant. So
yeah.
yeah.
So that's something that I love to do. I love to acquisition. I like to underwrite deals, and there's a lot of them out there. But then we also want to get this agency type of loans, with like a lower interest rate. Also, we don't want to take over some loans that's already matured and they're swimming underwater. And even if you take over the payments or whatnot, if the occupancy and if the place is really disastrous, it takes so long to stabilize that asset, So we've got to be really careful on underwriting these things, and that becomes more challenging,
Yeah.
Once it was a class C, is now class D because it's the way it was run, and it put the wrong tenants in there. And now it's like a very bad area, or
Yeah.
stuff like that. We've got to really be careful of. But we're constantly looking from the multifamily. We're still buying in these areas. And another asset that I'm really looking at is like a single family to put it into our personal portfolio also. And we're constantly looking at the like fixing it up, and then putting tenants in there. We do cash out refi. I guess they call it like a burst strategy.
Yeah. Mm-hmm.
Very similar to that. So we're constantly looking at those markets. I'm in Georgia, so I'm looking at like Atlanta markets and somewhere around here. Also, we're looking at like Birmingham markets. Is dirt cheap.
Yes.
But then you have different tenant quality, so you got to be careful on when you go to out of state, what kind of demographics you're dealing with, and what kind of meaning what kind of tenants you're dealing with. Are they payers, or are they just kind of making excuses why they cannot pay rent to you?
Yeah, definitely do a deep credit background and all those checks.
Yeah. So like those things that we're focused on. And then previously we mentioned that the tenants are like the most important partners, like we mentioned that, right? So
yes,
because they're the one who pays rent. So instead of dealing with this like a single family tenancy, what if the Dollar General or Starbucks are your tenants? Because they're
on the commercial side, yeah,
like a triple net investment. So we started to kind of look into those type of investment grade too. But the cheapest thing you can probably find is like you can find things under $1 million. But then if you have a decent asset, like on a decent location, you got to be paying like 2 to 3 million at the least, to make it worthwhile.
Yeah, and I would imagine those are more than like a 5 or 7 year hold, as long as the business stays there, right?
Yep.
That's
so it's more like so you're kind of buying for their lease term.
Okay.
So if they just bought a brand new build, like they bought a lot. Let's say you and I are investors, right? So Larry, let's do something together.
Yeah.
There was a great lot in close to Orlando. Oh my gosh, the land is like this much. What we can do is we can zone it to put like Starbucks in there or Chipotle.
Yeah.
Let's build the building, and let's partner with these companies because they want to go in there. So we build it, and we've signed a lease with these people, typically like 20-year lease.
Yep.
So let's sign a 20-year lease with these people. And after the 20 years, the rent bump's going to be like in a certain amount every 5 years, or however we structure the lease.
Okay.
And then if something goes wrong, it's on you. So it's called the absolute triple net, because absolute means like we don't do anything. All we do is collect check. If something goes wrong, tenant, you're responsible for it. Taxes and insurance, you guys cover it. Like we're going to pay it up front, but you're going to get reimbursement for it. So that's called absolute triple net. And then, and every year I'm going to jack up your rent 2% every year. So in 5 years, that's 10% total. But some people say in 5 years, we're going to jack up the rent 10%. In next 5%, in 10th year, another 10%. Like, different structure.
Yeah.
But anyway, that's the point of the lease. And after the 20-year lease is up, and then you have like the option to renew the lease. Like there's like three option to renew like 3 times after the lease expires. So that's another 5-year extensions or whatever.
Okay.
So we can structure like 30, 35 year, like.
Oh, nice.
And that's like a mortgage. So by that time, it's all paid off, right?
No, that sounds awesome.
Yeah. And that's the kind of game that maybe it's also not too many people are involved in. Because what if these people leave and then what? And it's going to be so hard to find another Dollar General to put in that same lot. So it's not like a single family residence. Some people leave and clean it up real quickly and then you rent it like in the next month, so the turnaround is very quickly for a single family, but these type of commercial is really long hold. So you got to know what you're doing and you need to know these companies that are looking, and you got to know a lot of brokers in the area. So it's tricky, but it's very interesting to me. So I'm talking to a lot of people and learning about that. So I'm a newbie at that. So I'm a student to try to understand the triple net leasing. So that's something that I'm also interested in.
Yeah, that's awesome. Yeah, I feel like there's a lot of cool, lucrative asset classes out there. I know a lot of brokers are hitting it big with like car washes and self-storage and mobile homes, all that stuff. Those
are great assets. You know what, Larry? Another one is like a data center. There's a lot of data centers that's going up with Microsoft, and also like like a BlackRock is also putting like a QTS everywhere in the data center in the South region.
Okay.
Like that's a huge amount of money there. So you're talking about industrials, and there's a lot of warehouses from Amazon. They're all constantly looking. Like those type of investments is also like a niche market. So, that's where a lot of the money is also going to.
That's very interesting. That's actually like my W-2. I'm a data engineer. So that's definitely right up my alley. That's
AI. What sort you're helping these data centers to, put it up and make money from there. But so there's a lot of great opportunities out there. And what I call it is like a shiny object syndrome. Oh, that's great. Triple net, this and this and that. And we're studying so many things and watching YouTube all the time and going to seminars and networking. And your brain starts to spin, because now that I'm like, I like this one too, I like that one too, then you're starting to touch on a few things, but then a year goes real quick. What had I done this year? I've studied, I talked to so many people, but I haven't taken any action to buy any asset. I learned a lot, but I didn't buy anything. It's kind of like those things. And I went through that maybe a couple of years ago, but it's like, we have to take action. We have to buy asset class. We need to buy asset, run it, cash flow it, replace that cash flow with your W-2.
Yeah.
But then I'm not saying like replace the income with the W-2, meaning like replacing that, like your quality of living.
Right.
If you can hold the W-2 as long as you can, I wouldn't leave that company.
Yeah, I've been doing data engineer for going on 25 years.
Okay.
So there's a lot of verticals I want to get into, but it's kind of like what you said, is like sometimes you're just a student and you can't take action until you have everything in the right in line. But I also heard too is like, even though boring isn't that satisfying, it's a winner, because you're making money, and it's may not be the best asset classes out there, but like it's something that you can do, get passive income, and until you maybe graduate to another asset class, it's something that pays for your lifestyle and all that stuff. So
I think the best asset class is what we know.
Yeah.
People say, hey, if you're just doing single family, then your mind is too small. I wouldn't believe that at all. Keep doing it. I don't care how small it is. It's yours.
Yeah.
Grow that. as long as you're making income, you're having fun doing it, I'll definitely not stop doing it just because somebody says, hey, your mindset has to be bigger, going to like 100+ unit in apartment buildings, or which is great and everything. But I tell you, apartment buildings are very humbling, and you're going to learn a lot. There's going to be a lot of wins. There's going to be a lot of losses. There's so many challenges going on. Like every week we have asset management meetings, and there's always conversation around very tough thing that's been happening. And then how do we turn it around? How do we do this? And then, if you're surviving these markets, and then you're cash flowing, and then also you're taking like your capital is in there. So you better, like, we all better, make it, like, survive it.
Yeah. Yeah. I mean, even if you're not cash flowing all that much,
yep,
whenever you sell or refi, you hope that the numbers penciled out.
Yep.
When you first got into it, that you're doubling or tripling your money, and then rinse and repeat, right? On to the next.
Exactly. Especially like today's market, like if you're investing in multifamily, I tell you, it's a great tax advantage for sure. Like if you want to save money on your like K1s,
yeah,
those are like great, So work with the investor, the sponsor who's going to release your K1 before your taxes are due, because a lot of these operators just released the K1 just now. Like it's in May, right? Taxes are already due, but they're releasing K1s now. So you be ready to file for an extension and whatnot. But anyway, great tax advantage for multifamily, especially with the Donald Trump 100% bonus depreciation is in effect. So it's awesome. So that's definitely a sweet part of it. And second part is like, if you really structure the business plan, underwriting very conservatively, in 5 years, you really know how to exit. So our exit strategy is to take all this multifamily, put them into a portfolio, and sell it to the institution. That's what our vision.
Yeah.
Not the individual investors, but even then, we still keep some like meat on the bone, because we don't want to over renovate. Everything is done perfectly, and then the next investor comes in. Yeah, just enjoy the cash flow. Yeah, there's no value add because we did it all. Like, there's no attraction in there, right? So we got to keep some meat on the bone, and we don't want to get too greedy, because the next person in line needs to make money too. And then, hey, this is what we've been doing, and you guys can finish it up. It's been working for us in this certain manner. We've transferred that knowledge to these new investors, like the following investors after us. So the exit strategy. So meaning like making tax deduction, tax refunds, like those are really beneficial today. And also at the back end, the sweet equity is something that, that we're all waiting for, from the market to turn. And the cash flow, with a lot of things that's going on right now, it's getting a little bit tighter because the rent's not really super increasing as we also expected. It's starting to flatten out. In some areas, it's also going down.
Yeah.
And if these operators forgot to underwritten, like the rents are supposed to go up every year, but then nobody really underwritten it flat or even going down. And can we still survive it?
Yeah, that's a great point. Great question. Yeah.
And that's how we get caught in the chin and say, how who's got to, just awakening, So then you mentioned, Larry, like some operators don't distribute, in a certain quarters because they want to still bank in that. It's not because they don't have the money. I'm thinking,
yeah,
because they want to make sure they have enough reserves in place in case something happens. So those in case monies are kind of, we don't know which direction it's going to go.
Right. Yeah.
So, we want to keep it safe. And that's a lot of reason why we, some operators stopped distribution in some cases. But if their loan is matured and their interest rate is up and they're not cash flowing, that's a different subject.
Yeah.
Like we need to really understand what's behind those numbers. So anyway, like those are the things that in multifamily, that's a beneficial, but cash flow is one thing that we have to really look for. Tax savings and also like sweet equity at the end. Like a single family, it's a little bit at a time, but it's ours,
Yeah, you have the control for sure. Yeah,
it's personal, it's yours. You're the kind of like a one person CEO with your wife or with your partners, but then that's yours, and that's something that's very personal.
Yeah, that's kind of also the personal play that I did, because like I knew on the business side with commercial, like I don't have all this money to where I go in on it by myself. But the single family houses, we can do that for sure.
Yep.
I was going to ask you one more question.
Sure.
And we're almost at time, but I appreciate you hanging on. How do you typically use like think about deploying, I guess, your capital across deals? Do you prefer using your own? Do you leverage others, or is it a mix? Like, how do you think about that?
I would say it's a mix. People say like, hey, never OPM is a term.
Yes.
So that means I use zero out of my pocket, and then I use everybody's money to make deals. It sounds great, and I know people doing that. But then, there's a trust issue when you talk to people on capital raising. If I don't have any skin in the game, then how am I going to raise money?
Yeah.
I'm using your money to make me money, and hopefully I'm going to make you money, but I don't have any risk.
Exactly. Yeah.
So, Larry, do you want to partner with me? Like, it's kind of like those type of discussion, right? So that's why I want to make sure that I am the one who's putting the most money into the deal that I believe in. And if you want to piggyback on that, then sure, please, I'm going to give you an opportunity to invest with us because we have a lot of experience and people wanted to get involved in real estate. So it's a hybrid of that. So in that sense, definitely my money, investors' money, if they want to. I'm not going to force anybody or convince, anybody to, hey, invest with us, you're going to double your money. And I'm not pitching anything. So
right.
If you want to, that's great. If you're not, perfectly fine. And just exchange notes to see how your properties are going or how that investment's going. And then, we're always learning from each other from that perspective. But, and then other people's money is mainly like the capital raising from that, like pref equity or like the senior debt. The banks are other people's money too. So the debt piece is extremely important. So we definitely utilize debt for sure. And also got involved in the commercial mortgage industry recently.
Okay.
Number one, to save myself money from buying like a single family and also like buying a multifamily also, because the origination points and also like a back end spreads are something like how these loan originators are making a lot of money there.
Yes.
You're wondering why the interest rate's so high is because they're making money on the back end. And then, you can get like a par interest rate on 6.5%, whatever, then I'm just underwriting my own loans and I'm saving a lot of money doing that, so, and that's other people's money from the bank perspective or the lending standpoint, but I'm also saving a lot of money up front by not putting any origination fees or any other points or any of that stuff. So, and the reason I started doing that, Larry, because I'm advocate of the animal rescue.
Okay.
Because what happened is like one of the HOA managers, called me one day, like last year. It's one of the properties that we own. And she called me and said, hey, I found this like a dead dog in this compactor, like a dumpster.
Oh, wow.
And she sent me like a picture and I was like, where's the dog? But I see the dog's face and then, you can see like the boxes and the trash on top of the dog.
Oh, man.
Oh my gosh, it's like devastating. He said, this is a crime scene. They got police involved and detectives and they got animal controls and they found the owner.
Oh, wow.
But then the owner said, hey, this dog was, kind of died in an old age and I didn't know what to do. So I just had no idea, just throw it in there.
Oh my gosh.
He was in pain too, but it's kind of like, but still, like, why would you put your own dog into like a dumpster like that,
No, yeah.
It's crazy. Just bury him in the backyard, but I'm renting. So, it's not my house. So I didn't know where to bury or I didn't have a shovel or like whatever the excuse that this guy had. But that kind of really messed my head up. And I said, you know what? Her name is Miss Johnson. So Miss Johnson, we got to change this. And like, we have to do something. So you know what? I'm going to work for money right now. I'm going to become a commercial mortgage lender. And whatever the money that I make is going to go towards that cause. So that's why I started like a commercial.
Oh, wow.
But I'm very passionate about these things. And that's why I kind of started doing that. And I can save people money. Because I'm not there to make money on mortgage origination points and jacking up the prices. I'm not interested in making money there because I'm already making money in the investment side. So,
right.
Yeah, that's the kind of things that I really want to tell people. Say, hey, if you guys are having a bad mortgage and have somebody like me to kind of walk through the mortgage side of things, I'm here to help. Like, genuinely help. So that's something I really want to throw it out there too.
Yeah, yeah. That's awesome. I love that you're giving back and you're passionate about that. That's amazing.
Yeah, thank you.
Yeah. And so one last thing that I've done, and I'm kind of more of a financial strategist, where I've used certain financial vehicles to kind of recycle or reuse the capital more efficiently between deals. So I may have something to where I'm borrowing from my own bank to where I have money in a deal, in a real estate deal, but at the same time, it's also growing 5 to 10% year over year. Have you heard of those type of strategies, or have you ever taken advantage of that?
Yeah, I heard of like investment. In the how do you say?
It's kind of like a
What do they call it?
It's a dividend paying whole life.
Yeah, whole life insurance policy. Yeah, I heard that.
Yeah, is that something that you'd be open to, or have you ever done anything like that?
No, I know a lot of people who try to do that.
Okay.
Yeah, it's like we follow like a different strategy.
Yeah.
We do like it's called like infinite banking, I believe, right?
Yeah, that's exactly right. Yep.
Okay, we got like 3 or 4 different friends like who does that, and try to convince us to do that.
Okay.
But what I do is like in my own personal property right now, so we don't have this conventional 30-year fixed mortgage. I looked up this thing called like AIO loans. It's called like all-in-one loan by I forget who it was, but anyway, you can Google it, AIO loan. So you can pretty much like whatever you make, you dump it in this payment, and then if you need it, you take the money out. So you deduct in the interest because it's your primary house.
Yeah.
They put that interest deduction on your Schedule A, on your tax returns or whatever.
Got it.
But then if I really dump all the money in there, I can probably pay it off like within 10 years easily. Because everything goes there, because there's no way for me to just put them in somewhere earning like 3% interest on some MMA. But interest rate kind of fluctuate based on like CMT index is what they call it. But then I use that as a bank. If I need it, I pull it out.
Okay.
Like fixing flip loans, I'll pull it out from there. I put money in there, fix it up, refinance it, and put it back. So I use that as almost similar to like a banking.
Yeah. Okay.
strategy. So that's what I'm doing now.
Okay. Yeah. Interesting. Yeah. That sounds cool.
Yeah, that's awesome. So you're in Florida, right, Larry? My daughter's over there. So yeah, just wondering how's the weather out there?
The weather has been getting uncomfortably hot lately. Yeah, I felt like maybe back in March it kept flopping back and forth. There was like these cold fronts, like so one day it was cold, the next day it was hot. So I think we're back to like all dry heat right now. Where does your daughter live?
She's in the we're in a town called like Peachtree City in Georgia, like about 30 minutes south from the airport. But then she's a senior. She's graduating this year, and she's going up to NYU in New York.
Oh, nice.
Up there too. So I'm like, damn, like two kids are in New York, and that's where I came from because I didn't like the cold and I liked the warm. So I arrived in Georgia, but now both kids are gonna be up in New York, and then it's her final week, I guess, from before graduation. So her and her friends just took a trip down to Orlando. So.
Oh, okay. I got it. So kind of like a reward for the graduation, right?
Yep.
Nice. Yeah, it's definitely beach weather for sure. So
right. Yeah. Awesome connecting with you, Larry. I appreciate you reaching out, and hopefully we can stay in touch.
Yeah, definitely. If there are some deals that you guys are underwriting that I'd be more than happy to take a look, and if it's interesting to me, I would love to go in on it.
Oh, awesome. Excellent.
Yeah.
Definitely stay in touch, Larry. Appreciate your time.
All right. Thank you. Appreciate it, Joel.
All right.
Take care.
Okay.
Bye.